Welcome to the Cashflow Project podcast. Are you looking to better your financial situation by increasing your cash flow? Too busy to hunt for real estate deals or don't know where to start? Then you're in the right spot. Join us as we dive in and talk about investing for cash flow using multifamily real estate.
Welcome to the Cashflow Project podcast. I'm your host, Steve Fieros. Excited to have all of you guys tuned in back in for another exciting episode. Today, we've got Ben Mohr on the show. So Ben is a trusted leader in retirement and income planning with a strong focus on alternative investments and life settlements. Now, we're going to talk a little bit about actually what that means, because on the surface, it's just kind of a mouthful. And we talk a lot of shop here in real estate, but there's all kinds of different investment strategies. The show is called the Cashflow Project for a reason. We want to help to develop different forms of cash flow, and Ben's going to help guide us kind of through that. So he's a founder and CEO of Ben Mohr LLC, leads one of the top firms specializing in life settlement solutions, which offers expert guidance for complex financial decisions for people trying to navigate through that. Because a lot of times people may be in tight situations and may be in a unique situation, and Ben can bring to the table a unique solution which can help bring some clarity and stability to the situation. So Ben, I want to go ahead and welcome you to the show, and I'm excited to dive into this conversation with you.
Yeah, thanks, Steve. Thanks for having me. This should be an interesting conversation.
Absolutely. Absolutely. Now, I know, like I said, a lot of our listeners, we talk a lot of shop in terms of real estate, like all different facets, whether that be fix and flip, long-term rentals. Obviously, we invest into multifamily assets, commercial assets. But again, we're all about helping the listener base be able to provide solutions to their needs in terms of cash flow and helping them along their journey towards financial freedom. So we're going to dive into a little bit about your unique take on that and how you can help them to achieve that. But kind of before we get started, for those of our listeners that may not be familiar with you, give us a little bit of your background. How did you get to the Ben Mohr of today? You guys see some beautiful family photos there in the background. And I know you're over at California. So yeah, fill us in a little bit of your backstory.
I'll give you the elevator speech. Grew up in California near San Diego, wound up getting into broadcast journalism. I was a reporter for TV stations around the country for a good 2 decades, working for NBC. And then kind of realized at some point, I worked in the Bay Area, and this is during kind of the dot-com boom. So I saw a lot of people around me making a lot of money doing things. And I was like, okay, so I met some people. Long story short, I got into financial advising up there because there's a lot of people who have a lot of money up there to advise for. And one day when I was doing all of that, I stumbled across, I kind of call it a Forrest Gump story. About 20 years ago, I stumbled across a person who was looking for some advice, and they had this pamphlet on this thing called life settlements. And I was like, I had no idea what this is, was very skeptical about it. Went home, did some research, and after about 6 months of really researching it hard, realized, wow, this is something I've never heard of, and I think it should go out there. So I started doing seminars around town just to get a kind of test to see if anyone was interested. And it was like overnight, like my business changed. I was selling everything from annuities and stocks and and all this stuff. And all of a sudden I started doing these talks, and it was like, that's all anybody wanted to. I could tell you, Steve, I literally put like 2 slides in a seminar, and it was like after the seminar, that's all anybody wanted to talk about. It says sometimes, I don't know if any higher power, but it's like sometimes God just kind of slaps you in the face and says, come on, buddy, like what? And you just go, okay, I'm riding this wave, and here I am 2 decades later, and it's been an interesting ride, 100%.
Oh, yeah, I'm sure. And like I said, we're going to dive into a little bit more here, kind of what life settlements actually is, because that kind of, life settlements, I thought that is what we experienced before God. Like he's going to time to settle up your account here.
yeah.
But this has definitely much more to do with people who are still living, right, that have not exercised kind of the life insurance. But kind of give us, for those of us that are not completely familiar with what that means, it's obviously been transformational for you. And I know you've helped a lot of different investors invest into those type of assets. What is that? Like, can you give us a background of, or just in terms of, lay that out? What does that actually look like?
So the term life settlement is fairly generic. So I'll work both sides of the street. And where the big confusion comes in for people is when they hear the term life settlement, it's where a person who is older, if you want to call it a senior citizen, or what's the right term these days, usually people are age of 75, they have a permanent life insurance policy that they might have had for 20, 30, 40 years. Why did they buy it originally? For protection for their family, right? When they were working. Well, now they're in that kind of end of life stage, and they've got, let's say, $1 million policy that they're paying $30,000, $40,000 a year to keep in place. and they realize I don't really need this anymore and I'm dumping money in and I need money for end of life care. Maybe it's to hire somebody to do some part-time assistance around the house. They could then go ahead and sell that thing for maybe, depending on what their health is, what their gender is, all that kind of stuff. They could maybe sell that policy for $300,000-$400,000. Okay. Now, where this gets confusing for people is that we're not on that side of the street. We're not helping people sell their policies. What we do is we are buyers. So we buy them, but then we do kind of give your listener who are here understands flipping. We're buying the houses and then flipping them. And what we're doing is we package not just one policy, but we put like 5 together. And that way, someone like who wants to invest, they don't have to commit $300,000 to buying Aunt Gladys's policy from New Jersey, right? They now are diversified they can come in as little as $10,000 or $25,000, even with their IRAs. And now they can just have bits and pieces of multiple policies. And that's what we provide. There's not a lot of people in the world that provide that opportunity for the investor to say, hey, I'd like to get into this space. I don't want to buy the whole house, Steve. I would like to be involved in a syndicate that's going to allow me with my IRA to buy 10% of the house. Or buy 10% of 10 houses. That's what we do, right? We offer a closed-end fund where you can come in and just drop a little money. And the reason that people like it is because you're diversified, you're away from the market, which I would imagine your listeners get. That's why they're in real estate. Real estate is the first place anyone's going to go when they finally have that aha moment that the stock market is not the end all be all. Doesn't mean you shouldn't have money there, but there are other ways to make money. And of course, real estate. What we are, I kind of say, is we're that next train station down the road. Once they've gotten enough real estate and say, maybe I should just take a smaller, I would like a little extra sliver over here doing something else because, and I'm not complaining about the real estate market, but it has its cycles. When you buy someone's life insurance, there isn't a cycle, right? There isn't a cycle. It's not sexy like that. We're not going to have the booms that real estate has, and we're not going to have the booms that the stock market has. It's you're buying somebody's policy, and when they pass away, you're getting part of the earnings. It's that simple. There is no boom. There is no ebb and flow. It's life insurance, and it's not sexy, but you are buying something where you kind of do know the end result. We do know, right?
Yeah. No, that's true. And that can help to smooth out, let's say, for those of my investors and also my business owners, it's like, hey, we all know this can happen. Cash flow numbers, all that kind of stuff.
Yeah.
And then even in the current environment that we're in, right? We're in a high rate environment, got tons of increases the last few years on operational expenses, whether that be insurance, property taxes, let's say specifically for us in the real estate space. We're dealing with issues like that, which really start to cut into cash flow. So something like this could provide some stability in terms of smoothing out what that cash flow looks like month to month. Now, what kind of, obviously I'm familiar with real estate returns and kind of what could be expected. There's some benchmarks and whatnot like that. Let's say even for simplest residential long-term rentals, what can somebody be looking at for something like this? And I'm not sure if that's something you can talk about or
whatever. Oh, no, of course. Yeah, we just have to always do it with the parentheses of course, hey, if you bought 5 policies and everyone lived to 110, why it's a theoretical possibility. It's not probable. So I'm going to talk about my own experience. I've been doing this 20 years. Let's just take this last year. We've had 3 maturities here in 2025. And those maturities combined total about $5 million. And the first maturity came back with a compounded interest rate because we have to do the interest rate at the end. When did you give us the money? What policies did you buy? And then we gave you the money back. So that's how we're going to figure out with the compound interest. The first case came back with a 10% APR. Second case came back with a 12.5. And this last case came back with nearly 20% APR. Now, those are good numbers. That's what we do see. We haven't, with the companies I'm working with right now, we haven't seen anything low digits. I would say to people, to just give them a decent feeling is you should see single high digit returns. You could see lower double digit returns. No, 7 to 12%, something like that. The key here is, and I think you'd understand this, is you really want to be diversified here. The big mistake you could do is like, hey, that's why we offer a 5 policy program. We won't allow you to just go, I want that one person, because I cannot tell you how many times people have picked the wrong late person. I had around, Steve, one time where I had two policies and there was an older man. Just this thing about this. Older man, overweight, depression, the whole thing. Wife had just died. Bing, bang, boom. You're going to go, hey, I don't want to be morbid here, but you're like, I'm going to mortgage the house. I'm dumping the money in. And then they had thin Asian lady, you wouldn't touch with a 10-foot pole. And I'm not trying, if anyone thinks I'm being racial or gender specific, go look at the oldest people who are alive today. They're all from like Okinawa. They're all Japanese, or you understand this. I'm not, I'm dealing with statistics here, right? And this is what you got to do. And sure enough, I got a call about 6 months later from the guy, from one of the carriers, and like, hey, somebody died. And I'm like, oh, that guy. And it turned out it was the lady. The lady had passed away, which was, this was an early death, right? And that guy wound up living longer than expected, and people would have banked their house on that, right? So that's why we want to be diversified, because you just never know. You never know. It's a weird business. I'm not gonna tell you. I'll give you an inside thing here. Is we got a call on somebody who passed away recently, and they were only 74, and they were expected to live into their 80s, right? So the clients made a ridiculous APR on this, because the sooner you get paid, right, the more money you've made as far as time value money. And she actually got hit at the start of the show. She actually got hit in a shopping mall, right? So the reason I bring that up is it's not like funny. The issue is, the reason I'm bringing it up is it just shows you that you never know. And we get those more often than not. It's, yes, people die of natural deaths, but as people get older, there's slips and falls. There's just a lot of things that happen that you just don't know. You don't know. And so what we tell people is, yeah, it's a good diversification away from everything. What we sell it is not so much on return, Steve. What we do, though, is we say this is money that is not correlated to anything. These cycles that real estate sees, or the cycles that oil and gas see, or any of these, can be determined on what economy, politics. Your number one thing, of course, for you is interest rates, I would imagine. Yes. None of that affects us over here. It's really simple. Like, hey, you bought 5 policies. These people are going to pass at some point. When they pass, you're going to get paid. And as long as they're living slowly every day, your APR kind of slowly just goes a little bit lower. But what's great about it is it's not affected by the economy. It's not affected by interest rates. We don't care. You're owning a piece of a policy, and that's it.
Gotcha. Okay. So that helps for me to brings a little bit more clarity.
Yes.
I think in kind of terms of how to look at it. So it's small enough where you actually see kind of who you're invested into. It's not that.
Oh, yes.
It's not like, okay, hey, I'm investing into a REIT or something like that, where it's very broad. Hey, I'm buying a portion of 100 policies or something like that. It's not that big. You have more direct control, I guess, over. Got it.
Yeah. Well, the issue there is that I think in this industry, even though it's been around for a while, it's not like there's tens of thousands of policies out there that are purchased. Like, I deal with a group in California that is probably the biggest purchaser of life settlement policies for this manner. And I'm going to say they probably own less than 100 over a 10-year period. So that's the key. The second thing there that you're talking about is, it's what we do, because I'm going to lead into the question there is, yes, our clients get what are called life expectancy reports. We have to be fully transparent. I always say this, it's from the real estate side. You're not going to walk up to the front of a house and say, oh, and the owner just goes, yeah, everything's good. Roof is good. Right? No, you're going to get a home inspection done. We have home inspection, so to speak. It's done by a doctor. It gives you the information. The one thing people always say, no, we don't give out their name. We don't give out their address, right? You have their age, you have what state they're from, you have their weight, and it has all of their medical history. It has all their social history. So it'll tell you what surgeries they've had. It has their lab tests reports. It has how mom died, how dad died. I know it's a weird conversation to have, but this is what you would want to know. If you and I were just sitting around and kind of guessing how long somebody was going to live, these are the basic questions you would ask. Is genetics is a big deal. How did everybody in this family did your mom live to 95? All those kind of things. What do you do for work? What's your education level? All those things do factor in. Are you still married? Did your spouse die? Drug interactions. These are all the things that we give you to show you this is how they come up with the life expectancy report will give you a date. It actually gives you a date. Now, of course, it's never right, but it gives you the workings of how they come up with why they think this person's going to live 4 years or 6 years or 8 years, right? Actuarial tools. Yeah.
It's kind of interesting because it's like, this gives you, because they're looking at all of the factors that say that, okay, hey, this is what the life insurance companies are looking at.
Right.
It's an interesting take on, wow, like you could take it as an investor in these things. Hey, these are all the things that I actually need to be personally mindful of if I want to live a long life. You know what I mean? Like, how many of these boxes am I checking?
Yeah.
In terms of how does this thing look? Obviously, none of us have control
No.
one day to the next.
Right.
But
I agree.
But there's some things that we can do.
Absolutely.
That help give us a kind of a longer, healthier life.
Yeah. I'll tell you that, Steve. Like, I got married, had kids, and we all go through those phases where, hey, got to go make that money. You got to go work and hustle. And now you're not getting to the gym and you're not getting good sleep and all that stuff. And now you're grabbing the In-N-Out burger or Chick-fil-A. And all of a sudden you turn around and you're like, what happened to me? I just put on 50 pounds over 5 years or 7 years. I was about 245. I'm 6'2", and just did not look good, did not feel good. But business was going well because that was all my struggle. But yeah, as I started reading more of the reports, Steve, I go, oh, okay. And I'm in the best shape of my life. And it's because I think I never thought of it. It's because I deal in this industry and I'm so in tuned with all those things that really are critical. I have an anti-aging doctor and I do all these things because that's it. Your health is by far the most important thing. And if you just ignore it, that's all you got. No money in the world is going to help you that. So yeah, it has given me a different reflection as a person as to what's important. I never thought of it that way. So it's a very great perspective there.
Yeah, it's just something that came to my mind as we're talking about it.
Right.
And I just got back from a trip too, and I realized, man, like anytime I travel a fair amount, and so anytime I travel away, it's like, well, hey, I'm in Texas, man. I want to eat some barbecue. I want to eat some Mexican food, and it's like, but if you're eating that every day, it's like, oh yeah, man, I started to pack on the weight, and I can already feel it.
Yeah.
Now, I do have a question on the term, like in terms of the people that are, let's say, selling these.
Sure.
Now, like selling the policies themselves. Do you have any control over that side? Is that a part of the business that, like, let's say, you as an individual are working, or is this more you're dealing with an intermediary who is actually providing that service, let's say, to the individual?
We buy it on with a great question. You could do it that way, but the problem is think about this. We buy it on the tertiary market, meaning that we're buying it from somebody who bought it from somebody else a long time ago. And we buy it from a very trusted group. I think they're the number 3, what we'll call them a wholesaler. I think they're the number 3 wholesaler in the world. I've had a great relationship with them for 20 years, so I trust their value. I've seen how their policies work and how they pay off and the details they pay attention to when they're picking the policies. So that's what I have. You have to do that because you will lose your mind. To give you an example, I believe that they have to scour these policies very close, Steve, because insurance policies can be confusing. There's anything from you and I talked about infinite banking. So what we're talking about is an IUL, an index universal life fund. There's VULs, variables. These things have little niches and hidden. It's like going through a landmine. Like, you got to know what you're doing. You can't just go buy someone's policy because some of these things could blow up in your face in 10 or 20 years. And what I mean by that is it's like is that you come in and buy some variable mortgage and find out that in 3 years the thing goes from 4% to 12%, right? You're done. Yeah, you're going to lose the house. So you got to have somebody who knows how to vet them. And I work with a company that does that. They know where all the problems are. And then they just take care of it. They bundle it to us and then charge us an additional premium. They're like, this is what you bought the policy for. And then they charge me XYZ to go get that policy. And there's lawyers involved in all of that. So it's nice, bundled and done. You have to do that because I know for a fact, I think they wind up buying for me 1 out of 25 policies they enter discussions with. Could you imagine? I don't have time for that, right? You get halfway down the road, you order the reports and all this stuff, and then they want an extra $5,000 and they fall out, or one of the people in the family doesn't want to do it anymore. That's I would, that by itself is a full-time job. So yeah, no, you wouldn't. Well, it's the idea. I say people always think like we're knocking on the door in Boca Raton looking for people. No, I have nothing to do with the selection process. I'm all about the capital raising and dealing with investors. Right.
Yep. I got you. I was just more curious as to.
Yes, it's a great question.
when I heard you mention earlier too that they can use retirement accounts, okay, I'm like, well, then they're a QI, like they're qualified intermediary, and so it's okay. Then they got to be legit in order to do that, and basically to get the status where they can handle retirement account funds, right? Because that is a great source of capital. Obviously, we've helped a lot of investors use that in terms of real estate purchase. But for something like this, it's like, okay, this is more niche product. So that's good.
I would say 70 to 75% of the funds that come with us are qualified funds, right? If for people at home, you're talking IRA, Roth IRA, old 401ks, et cetera, solo 401ks. I've been in this industry a long time, so I've dealt with practically every single self-directed IRA company out there. Well, I know you have your people. I won't, if you want me, I'll give them a shout out. If you're curious, I don't know if people are able to use their own people with you guys, but we use one company. We're open to using other companies, but if they come to us and they have no dog in the fight, we want to go to this one company, because think about this: we're getting a $3 million payout this month, right? That $3 million, let's say $2 million is going to go to the IRA group that we're working with. They're going to send the full check to that company, and then they're going to divvy it up in the accounts. Right. So you can imagine what a nightmare if I had 50 people that are in 50 different IRA companies. The trust company that oversees this has to chop it up. So we prefer to go there. Plus, we have a dedicated source of this place because we do enough business, which is really key for us, to where we can call them. I know you and I have been through this, not the send an email, get the wrong response 48 hours later, send another email, can't get on the phone. So that was key when I came to this company. If I said, I don't have a lot to ask, but the main thing is I need to have a dedicated person. When somebody isn't happy, I want this dealt with in hours, not days. And then I just want to make sure that there's good connection with our clients, because that's the number one frustration. And the fees, I said the fees got to be fair.
Yeah, 100%. And then I'm curious too. So whenever these like that, okay, if one of the policies actually pays out, that goes.
We like to say matures.
Gotcha. Okay.
No, I'm just it's
using parlance for
that's our euphemism. You got to have a little laugh at this, like, hey, when the policy matures. Yeah, but no, I hear what you're saying. Yes, go ahead.
So I could totally see where running it through, let's say, your retirement account actually makes a huge difference, because then you're looking at tax applications now, because it's not from kind of what I'm gathering. It's not like a smooth cash flow. You're really waiting on the maturity of the policy, and then effectively it's kind of lump sum. Okay, cool. Then that goes to the intermediary. Obviously, they're going to divvy it up to whoever's partial owner, or it's going to go to the retirement holders or the account holders.
Yeah.
So there would be significant tax implications, just like how we would experience, let's say, on a capital event for, hey, a property sold. Okay, great. Okay, that's going to be a large payday. You don't want to just receive that necessarily as active income. That there's a massive tax hit, like in terms of income tax. So I totally get where a large percentage, it sounds like, funds actually invest through their retirement accounts.
Correct. So, yeah, and the whole process is pretty simple. I'll take you from start to finish. Is we check up on all that we have. Look, we sign papers when we buy somebody's policy that they have to legally do certain things, or we can go sue them for more than they ever gave us. It's an implied agreement. We just don't give you $300,000 and then, hey, see ya. We have to really kind of track you, and we have a right to track you, and then there is an agreement. So the way this works is, the first angle is that we will call you multiple times a year to see if you're alive, right? And if you don't pick up the phone and talk to us after a certain time, because let's say you've gone to the store, well, then we know who your wife is, we know who your family is, and we'll work down a contract tree to make sure you're alive. That's one way that happens. Another one is that we tap into the Social Security database, which we have access to show if any benefits have been shut off. Because as soon as somebody dies, that's what happens. But one of the major ways, and this is social media these days, you and I think you're probably a little bit younger than me, but we're used to people putting obituaries in the newspaper. That's how it was. My grandpa used to look at that all the time when he was in his 80s and just like, oh, this guy's younger than me. I was like, that made his day when he was in his 80s reading. And I've seen a lot of older people do that. Where that's changed now is, how do we let people know? Look, my father died maybe 10 years ago. How did I let people know immediately without having been bombarded by people with calls? Is I put it on Facebook, I put it on Instagram. So we follow these people's families' Instagrams and Facebooks, and that's one of the ways that we also find when people pass. Now, when they pass, we have to put in the death claim. We have to get the death certificate, put in the death claim. Whole thing can take anywhere from between 2 to 6 weeks. Money comes in. If you're with non-qualified money, i.e. cash, you're going to get a check from the trust company, and most of the money that you made there is going to be a capital gain. Okay, it's going to be like a capital gain. If you're, like you said, if it's IRA Club or the company that we use or self-directed or whatever it is, whatever self-directed company you use, yeah, it's just going to be in your account. It's tax deferred, right? It's no different, like you said, of selling its stock or whatever. And that's what the bonus here is. We do a lot of Roth conversions, tons of Roth conversions. That money's tax free if you do a Roth conversion. And we have a whole plan for people on that if anyone's interested on Roth conversions. Another area that we work with very much too is if you have an annuity that you hate. I used to sell tons of annuities, so I know them. I know the ins and outs. If you have an annuity and you're like, this thing is garbage, I got suckered into this thing 5 years ago, but I can't get out because of the surrender fees, we can help with that. We have what's called an exit plan for the annuity trap, to where people can go ahead and come to us. And if they work with us, we'll show them how they can get out and not have to deal with those surrender charges. So that's a big area too.
Yeah, that was going to be, that's another question that I have. It's like, well, who is the person that's actually selling, let's say, the policy? Because again, just to kind of bring it back for me, from our listener base, hey, we're used to, again, you're going to find distressed sellers, whether that be a distressed property, or typically it's going to be the distressed property is coming from a distressed situation, whether that be a death in the family, that's a health issues, kind of very similar here, or job loss, divorce, all these different factors that would put somebody into distress. Are you seeing the same thing, let's say, or is it more like how you mentioned earlier? It's just like, hey, you know what? I'm older here. And honestly, I just, because guys, for those of you listening, I know a lot of us are still on the younger side. You can do all of that, everything, you can take care of yourself. In the life care or something kind of on the back end gets very expensive. If you want live-in care, if you want to go live into assisted care facility, there's some places here locally that are expensive, like really expensive. So you're basically providing liquidity for these people to go and actually, hey, you know what? I'm going to live out my last 10 years. It's getting hard for me to be solo and kind of live on my own. I'm going to go get into a facility or something along those lines. And you're providing the liquidity kind of through this process. Is that, am I gathering that?
Yeah, I don't think we hit a distress like, oh my God, I got to sell this because I'm going to lose my house kind of situation. I think it's just hey, I'm 82. I've had this policy for 30 years, and it's twofold here, Steve. The first off is like, think about this. Let's say you just had somebody who came in like a CNA, like a type nursing, like let's say the family hires somebody and let's say it's $60,000 a year. If you don't think that's little, you're crazy. That would be somebody probably coming in every other day, maybe a couple hours a day so now you have the 60,000. But here's the thing. Now comes the bill for your $1 million life insurance policy, and people don't realize that, trust me, it's going to be $40,000 to $50,000. So here's the deal. You now have added an expense to have somebody come in and take care of you part-time, and now comes your bill. That's a $100,000 swing. So instead, you could get rid of the $50,000 that's costing you and now apply it to that side and then get the money now while you're alive. Why would you give your family, people might go, well, but it's $1 million. Yeah, but it's $1 million when you're dead and you're not factoring, what if you lived, say, 5-6 years? You're putting in $300,000 to get $1 million. What is your net gain? It's $700,000. You could get $400,000 today and use that money while you're alive. Some people, Steve, are just simply are like, I would rather have the 4 today than give my family 7 because I'm giving them the house, I'm giving them my retirement accounts, they have everything. And by the way, Steve, think goes, somebody dies at 85. My mom is in her mid 70s. I'm 51 years old. I mean, at the point, if she, God bless her, hopefully she lives a long life. If she lives another 15 years, I'm going to be in my mid to late 60s. I don't need her money, right? I've got my own life. So these families don't need that money. They'd rather have, why not spend the money on your grandkids' educations and helping people out so you can see what you've done for them. So it kind of makes sense there. It's like, yes, some people are using it for end-of-life care. Others are just deciding, I'd rather cash out and enjoy that, take families on trips or whatever. But yeah, it's a myriad of that.
Yeah, I was gonna say, like, it could be. It's just, hey, it's a quality of life, man.
Absolutely.
And I could easily see that being kind of a high, like a driver for people looking to kind of exit their things. It's like, well, yeah, I don't have 400 grand or whatever sitting in the bank, but man, I'm still healthy now. But gosh, I'd really like to go enjoy, and like to your point, right? I'd really like to go, hey, come out to here to Hawaii
Yeah.
and take the family on
Take
some
the
trips.
family.
Go spend a year or something out there, or 6 months or whatever, just traveling and visiting the kids, visiting the grandkids. So like, yeah, I know I could totally see. I don't know. I'm just trying to get an idea of like, all right, well, what solution are we providing like in this manner? And
Yeah,
yeah, no, I totally get
we
that.
think it's a win-win, and
Right.
it's providing people end of life care. That here's the thing: people realize there's a huge misnomer on long-term care. We can get into this conversation where people think that long-term care is a full-time solution, and that is BS. A long-term care program will only usually provide you somewhere between 3 and 5 years worth of care. Okay. Here's what long-term care guys don't tell you. They do this one. I've been to their thing where they go, turn to your left, turn to your right. 1 out of 2 people at some point in their life will need some kind of form of long-term care. That's why you need it. What they don't tell you is that system is rigged to where that the average person who goes into one of these long-term care facilities will go in for a matter of weeks or months and then get booted because either you've gotten healthy, Steve, from whatever it was you did, or you're not recovering and they want to dump it on you to go home. That's when the long-term care insurance kicks in. And the issue there is if you look at any of these policies, I have people think like, oh no, I've got long-term care. It's going to cover me. So I go, no, there's a maximum benefit on there. And if you do the math, in California here, I had a client who had a stroke and had to go into a place where they were sharing a room and the place was god awful. It was not nice, right? It was god awful. And they were paying $6,000 a month. Right. And this is the low end, folks. This is the low end side. This is not high end. This isn't the steakhouse. This is Jack in the Box, so to speak, of long-term care. $6,000 a month. $6,000 a month. So think about that. How long are you going to have money that's going to last there? So this is where a lot of people don't have long-term care because they either didn't qualify or that they realize that it's really just a Band-Aid. And I think that guy's long-term care program might have kicked in for $3,500 a month. And so it wasn't even covering his low end. If you have the high end care, you're not gonna, it's gonna run out in 2 years. So that's what this is this is a self-planned way of having your money to deal with long-term care.
Yeah, it's putting the control, I think, more in your hands too. You get to dictate as the owner of the policy, like, hey,
Yes.
where does this money go towards?
Correct.
And just to kind of confirm kind of what you're talking about, let's say the long-term care. Like, so locally, one of the businesses that I own is a residential and commercial property inspection business. So I can't tell you how many properties I have actually been into
to get
that are long-term, that are care facilities.
Yes.
And I'm just, like, do you feel for the people? Because they're typically looking to exit these properties. And so, or somebody's purchasing them.
Yeah.
And so like they bring a company like us in to come in and just do an evaluation of the property. And so like I see actually the facilities that the people are living in that they are paying thousands of dollars a month to. And it's just like, gosh, man, I wouldn't want my mom living and it's costing thousands of dollars a month. And so I totally get that. And so
well, the other thing that we have here is, and this I tell us, and it's kind of, we all have families. And so what happens is we'll run to a family, let's say grandma's needs some help. She's 82 or whatever, the story that I kind of bring up, and you'll have 3 kids and one of them will be like, no way. We're not giving up this policy for $400,000. It's $1 million. And we'll go ahead and pay that premium every year. And it's like, oh, okay. Do any of you have relatives like I have that when the bill comes, all of a sudden they have excuses on why they can't share? We all do. I'm not going to name them in my family, but we all do. Now you're causing family drama, right? And they're all like, we're going to help out with helping grandma. And then your cousin Jody missed her shift on a Tuesday to go out with her boyfriend. And no, this is like, you know what? Here's the money. Everybody is done. You didn't go hire somebody, hire a CNA. That's what I told people. Every time these people kind of fight back, I kind of give them, I go, I've seen it every time, guys. You're looking at family. What is family drama worth? Never talking to your cousin ever again. Is that worth your cut of $100,000? Ruining families over money? Because it's, my God, I could say in my family, I know 3 or 4, I'm not involved, but I know 3 or 4 factions of my family that you can't have together anymore because they're fought over $50,000 in an inheritance, right? Jeez. No,
I've seen it
this
before
is
too. I've
just,
seen it before too.
yeah, it's terrible.
Yeah, yeah. No, I've seen it before. And like I said, this is, I guess I'm just taking kind of both sides of the coin here and just
Yeah,
trying to understand, like, for one, as an investor, got the investor hat on, but then
sure.
also two, like, who is this also providing value to? Like, who's the person selling? And so
Yeah,
it's actually a huge deal because most people don't. That may not be you and I, Ben, or like any of our listeners, but a lot of people are really going to have a hard time with liquidity. And so, like, once
yes.
they get later in life, it's like, hey, especially with all the inflation that's been happening, rising costs of everything, housing,
Yep.
groceries, all that kind of stuff. And then now you have to come up with that additional payment, let's say, to take care of either the care facility or the life insurance policy because grandma's income, let's say, is not
Yeah.
covering what it's taking to actually
Yeah.
support that policy anymore. You start to get that cash crunch where it's just like you just do not have the liquidity anymore to do it. And so
Correct.
this is providing an injection of capital of liquidity back into the hands of the family to the individual to say, hey, yeah, you know what, we're going to go do this. We're going to do this well. We can
Right.
still live out the time in a much better way. We'll have direct control over it. And yeah, no, I could easily see where
Right,
this
and
is
it's
providing
they're
value that way.
they're unwanted, they unneeded, and they're unnecessary. Why does an 82-year-old woman need $1 million life insurance policy? She doesn't. The reason they had it was insurance to protect your family so that kids can go to college, mortgages can be paid. Well, now you're 82. Kids are no longer in college. They're 55 years old with their own families and their own mortgages. And most
Right.
likely, like my daughters right now are pretty much out of college. So that's all gone. That doesn't matter. So they're unwanted and unneeded. And it's like, okay, then what's the point of having this? Well, the issue here is think about this. It's like how you and I used to play as kids, the do-over. You hit a ball in the tree, you're going to get all your premiums back on this deal. So you think about this. You essentially paid into this thing for the
Right.
protection, and now we're going to give you all the money pretty much that you paid in. So you got free insurance for 30 years in case something happened, and now you're getting the money back at the end that you can use for yourself. You're essentially getting your money back that you popped in. I think it's a win-win for everybody, right?
Yeah. No, yeah. No, and like I said, that's where I think for me personally, it's important to understand kind of
Yeah.
who's the seller, right? Like
Right.
who's on that end of the
Yeah.
transaction. Because yes, as an investor, of course, like I can look at it to a certain lens. All right, what's
Yeah.
my return? Like again, it's
Yeah.
a movement of capital to generate a return. But
Right.
on the other end, this has that I don't say a moral component, but just kind of the
Yeah.
personal component
Well,
of like, yeah, I'm actually helping.
Well, they use the term compassionate investing, right? So I've had people
Gotcha.
go, it's like, it's hilarious. They got to look at their side coin. I've sat down with husband and wives looking to invest, and it's usually the wife. Okay. I'm not being, it's just because they're more they're more
Yes.
compassionate. So their thing is when they first look at me, they go, I don't know, I'm not comfortable doing this because we're going to make money when somebody dies. I just have a problem with this. And so then I look at her and I go, excuse me, ma'am. No, it's good. It's a good point. I go, but it's all how you vision it. And I said, okay, so how long have you been married to your husband? Oh, we've been married 25 years. I go, okay, do you have life insurance on him? She said, oh, of course. I said, okay, so when he passes away, you make money. So realistically, you have to really look at this and say that you're absolutely fine on profiting off of the death of people you love. But people you have no idea who they are, you have a moral dilemma, right? And she kind of looked at me and was like, yeah, insurance is insurance. That's right. It has not, Then the second angle I told her, I said, hey, what if you had an Aunt Gladys and she's 85 years old and she's got, let's say, $100,000 policy and she just needs to pay her bills and she's going to let this thing lapse anyway because she doesn't want to pay the $10,000. And she said, hey, why don't you give me $30,000 and I'll give you the $100,000. You give her the $30,000, 2 years later, she dies, right? When you get that check, are you feeling like a ghoul? No, you helped your Aunt Gladys out, pay some bills. She didn't want the policy anymore. And it's almost like a gift to you. She made that $30,000 turn into $100,000 for you. It was a win for you. I don't think you're at a funeral thinking that you are some leech. It worked out both for great. It's like she got what she wanted during her life. You made her happy. And now when she passes, it's like this nice bonus to you to get the extra money. That's the way you got to look at this. You're helping people. Yes, and at the same time, you're getting paid for it. It's what they call, some people refer to it as compassionate investing. I think that's just a little too syrupy sweet, but it is nice to know that that the money's going somewhere for a good use, right?
Yeah.
That's important.
Yeah, no, I gotcha. And then my last question, kind of before we dive into our fire round here, is there typically like a minimum amount of capital that somebody would need for this? It's like, well, hey, I've got 10 grand that I can invest. Is that enough? Or no, actually your minimum is 500 grand or whatever,
No, very simple. I'll go through the basics of this, and this is all on our website, which is Life Asset LLC, lifeassetllc.com. Is we got the brochure and the offering on there. If it's cash non-qualified, we can do as little as $10,000. If you're starting off with an IRA, we have a minimum of $25K, but that's with an asterisk. If you have some orphan account with 19,000 and change or 17, we'll take it. We'll take it. The reason we do that is we cover their self-directed IRA fees for 2 years plus the beginning. So you can imagine on $10,000, there's no meat on the bone for anybody. So that's what we do there. But if people have, like I said, they've got some old orphan account, we pick up a lot of those. People go from an old job, whatever. So that's how that works. And yeah, so that's where they can invest. And then right now, I think the current offering is, I think it's 6 policies in the portfolio. And I think the overall return is 77%. So elevator speech real quick here. Someone comes in and says, here's $100,000, qualified or non-qualified. You're going to own segments and portions of 6 different policies, the same percentage in every single one. And when you total up your death benefit on that, that'll be $177,000. So if someone invested $10K, it's $17,700, right? It's pretty simple. Yes.
Yep. Gotcha. No, that makes sense. Yeah. Appreciate that. And then, So well, now's the point of our show where we dive into our,
okay. I'm nervous, but let's do it.
All right. Well, I'll keep it. I'll go easy on you, Ben.
There you go. I'll bring it. Let's go. Whatever you want to bring.
All right. First question. What is a favorite book that you recommend for us, for people in the real estate space? For us, it's always Rich Dad, Poor Dad, because that's kind of our real estate Bible there, so to speak. But do you have a favorite book recommendation? And it doesn't have to be anything regarding this. It can be mindset. It can be, health.
No, it doesn't. First, I'm going to promote our situation is, again, if you go to Life Asset LLC, we have an ebook on this. There aren't any books on this. There isn't a book on this. So if you want our mini book, it's not Robert Kiyosaki by any, imagine the thing. But if you go to Life Asset LLC, you will see there is an ebook. It's like 30 pages. So no, that's not the greatest book I've ever read. It's just, if you want a book form, webinar form, it's there. I have a book behind me right here on my right-hand side. It's called The 100 Most Influential People in History. Here's what I believe. Remember, what is it that I'm doing for a living is I am getting with people, educating them, and trying to get them to invest. What is the number one thing I tell anyone who goes, what's the key to doing that? And that is connection. For me, it's connection. Organic, real connection, not phony connection. One of the ways that you can connect to anybody on earth is by having at least some semblance of an education on almost anything on earth. Doesn't make you an expert, but if you just have that simple low grade, we always say this, what is the number one thing people like to talk about? Steve, what do you think?
Themselves.
Absolutely. Well, if you can get them to talk about themselves, they are going to give you tips on things about themselves, where they're from, what they do, what they like, what's their ethnicity. Well, that book has small biographies on what this historian believes are the most 100 influential, not important, influential, how they influence the world. You're going to get stuff on science, religion, geography, history, so that if I talk to anybody, I have just little snippet of just about something about them. That book could give you a better education so you could kind of fake it till you make it. If I'm sitting with a guy who's hey, I've got a biology degree from Berkeley in whatever, there's probably somebody in that book that I can go like, oh yeah, I'm familiar with blah, 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 which the average person isn't. And he goes about, oh, do you have somebody in your family that's in biology? Oh no, I just read a biography on them. Instant connection, you're interested in what I do. That book, by the way, easy read. It's what I call a bathroom book. If I don't want to be too TMI, that's a bathroom book. You could get through that book in a couple months and literally have, I gave it to, it's the only read I told my daughters they had to read, period. And we took them to Europe when they were like 8 and 10, and everywhere they knew everything. They knew about the Michelangelo stuff. They knew about this. They knew that because of that book. I highly recommend people read that book because it will give you a much more, you'll become more interesting and be able to connect with people in any facet of life. 100, a ranking of the most influential persons in history, and it's by a guy named Michael Hart. And he comes out with revised versions about every 20 years because those 100 people, I'll give you an example, I don't want to bore people at home, I'm a history buff. 20, 30 years ago, all the people with the Soviet Union and the Russian Revolution were in that book higher up because that was such a big deal. They've now plummeted in that book because the Cold War, so to speak, on that level is over, right?
Right. Less relevant as we've kind of getting more recent history. Yeah,
correct.
No, that makes total sense. No, it definitely sounds like a very interesting read.
Thank you.
I will confirm that kind of what Ben's saying there. Like, again, if you enter into interactions, if you can find any way to connect with people, that's great. And so, like, to your benefit, to their benefit too. Again, like, you're going to engage with them in conversation. So it's really good.
Right.
All right. The next question: what would you consider your superpower to be?
I have almost a photographic memory.
Okay.
Yeah. So I have it's like file cabinets in my head. Steve, I have so much stuff in my head that I can't forget. You understand? That I wish I mean, we're talking innocuous, like who people come to me, who sang that song in 1983 that goes like this, one hit wonder. I know Bing Bang Boom. It's not to show off. I don't care. It's just in there, right? So that helps me a lot in business and in friendships and everything else, is because it's like almost like a computer file I can go to on, you want to talk about sports, you want to talk about this. I can just, I'm able to retain that if you ever met anybody I know, they'd say that guy has the memory of an elephant. He literally can remember everything, and they think it's like I'm trying to show off. I'm like, no, it's just, I don't know. It's my brain's able to just soak it in and hold it. By the way, it's very funny how it works. I couldn't memorize somebody's phone number to save my life. That's where the numbers are bad, right? But if you and I ever talked again when we had our pre-talk, I'll be able to tell you everything you told me. Yeah, you're from Honolulu. You went to Texas, had the barbecue. These are the things I pick up, right? And if you and I ran into 20 years from now, it'd be the same thing. I would be able to go like, oh yeah, okay, here's that and there. So that it helps a lot. It helps a lot.
Yeah, it's a God-given gift. It really is.
Yeah.
All right. And then the next question: if you could go back in time and have a conversation with your 20-year-old self, 20-year-old Ben, what advice would you have for him?
It'd be two things, and I've had this question asked similarly, is the whole thing of, and I really believe in this, and you've probably seen this in different versions on YouTube and stuff, which is this too shall pass. And I think people don't understand that quote completely, because what they think is they're thinking of it when they're in hard times, right? And what you have to understand is it works the other side of the coin. Things are going amazing. There should be that little bell going off in your head going, enjoy this, because this does not last. I remember one year, Steve, I was having a just unbelievable career year. It was like I was rolling over, and I was walking down the street and people were throwing money at me. It was just one of these things. I'd drive down the street and money was falling into my car. And I'm not bragging. It's just one of those years where it's like, I've had years where you can't do anything. This is a year where I was just stumbling over it. And I remember my kids and I were sitting at a nice dinner, and I said, hey guys, enjoy it, because we are at the top of the roller coaster. And they looked so confused. I said, there's no way I could sustain this. No. And sure enough, I think the next year was one of the worst years I ever had. The other thing that I would tell somebody at 20 is, you're going to go through things. We never learn from our successes. I don't think so, because we just enjoy them. Yes. And so what happens is, if you've gone through a death in the family, a divorce, a loss of friends, being audited by the IRS, whatever it is, while you're in it, you're like, oh my God, this is awful. But you will 2 years, 5 years, 10 years down the line have a similar situation and realize that is why I went through that. Like, I will tell you, I had somebody who worked for me that was awful, and it was awful, and we parted ways. And then I got somebody else, and I realized, and they were great, that had I not gone through that awfulness, and that person was available right at that time, they wouldn't have been available had I not gone through the awfulness. So I went through 18 months of work hell, to get this other person. And you're like, you don't realize, if you got your ultimate hire, they weren't available 18 months ago. And by the way, you wouldn't know what your ultimate hire is and what you really need if you didn't have a person who was so awful. And now I can think about that. It's like, I now appreciate it. I went through 18 months of complete ineptness to get somebody, so that I can value and understand how good that person is and what was missing that I needed, right? That's a positive. That's actually a positive. But I went through 18 months of garbage to get there.
Yeah. And then on the other side too, that person may not have been the ultimate employee or worker or
Yeah.
a partner 18 months ago. And so it's like,
Yes.
hey, they needed that time for seasoning because maybe they were learning from some failures that they were trying to
Yes.
navigate and
Yeah.
deal with. So yeah,
Yeah.
no, I can't tell you again, and this is a recurring theme that I've experienced over 6 years of kind of
Yeah.
recording this and talking to people, having great conversations. It's like the most successful people that I've ever run into are the ones that have failed fast, that have
Oh,
learned from
yeah.
their failures, and that I cannot tell you, we learn so much from the things that
Yeah.
don't pan out, that don't work out.
Yeah.
And you go back and okay, not doing that again, but we're going to
Yeah.
change, we're going to tweak, we're going to pivot and apply something to more positive in the future. So
I
I think
agree.
I 100% agree with your
Yeah,
sentiment.
when you talk about people who do well, they think, well, that guy's successful. I would say no, they're probably resilient
Yes.
and quick at adapting,
Yep.
right?
Yep.
And
Yep.
and to me, the number one thing I say to anybody, I think of this as far as a person that I'd say is attractive is just another human being, but I think you have to be this if you're in the position you are, is self-honesty is everything. If you can't look in the mirror and look at the warts and all and say that's okay and here's what we need to do. I live in Orange County, so I'm not going to hate on people here, but I run into people on a daily basis that I just know have zero self-honesty. The way they see themselves is they're either up here or they're the victim or that there's no accountability for what they do or a desire to change it. And my angle
Yes.
is if that's what you're going to be as a business owner, that when it doesn't work out, it's everybody else's fault, right? You have no control. But when you have all the wins, it was all you had control, you're going to fail. You've got to look every day and go, there is no business owner out there right now that shouldn't be looking in the mirror and saying, what could I do tomorrow to make it more successful for everybody that works here, right?
Yes. Yep. Absolutely. No, I agree with that. Well, Ben, how can our audience reach out, connect with you? I know that you gave your site earlier.
Yes.
Is that the best way for them to be able to reach
By
out?
far, it's a very easy navigated site. If they go to Life Asset LLC, click on there, it'll pop up. There's a little video. They can look at that. It's a little commercial type cartoon video. But under that is just our link tree. If you hit the link tree, it's going to show you there's a brochure for the offering. There's the current offering. There's an ebook. We just try to give people learn different ways. There's a webinar. By the way, it's not a sign up webinar. You get it right away. It's just a recording of it. So you can sit on your couch when you want, come in, come out. And then below that, we have our own podcast and we have our own YouTube channel. So they can kind of learn more there. Everybody, while you're brushing your teeth, you want to listen to this. So we just give everyone a myriad of different ways of learning from us because every person's different. And then there's a click button to do a Zoom meeting with us. And we have our phone number. So it's like we're no pressure people. We're here to educate and walk it through with people. Like you said, if people have old 401ks, old IRAs that they don't like, we can gobble those up and put this in. So you understand, and people coming in with real estate, that could be a lot of money, right? It could be a lot of money. Mm-hmm. With us, we're only talking about the worst 10% of their portfolio. So if someone's worth $1 million, we're not even going to take more than 50. Our average investor invests $50,000 worth at a time. Now they might invest $50,000 a day, but maybe because we always have new product, new rounds, they might invest another $50,000 the year after or year after. Who knows? But it's a very low pressure educational situation where if you're sitting out there today with your accredited investor with over $1 million, we are not going to sit down and go, you need to put $500,000 in. That's ridiculous. Our opening is going to be, let's start off with $50,000 and you're never going to be investing more than 10 to 15% of your net worth. So very low pressure, low key. What I would want to do with people is where's the worst performing 10% of your money? It's obviously not going to be with the real estate you're with, Steve. It might be like, an old CD, old annuity, money that's just not doing anything for you. Drop it over here. As we said, in the last year, we've seen 10, 12, 20%. I think you're going to probably be able to do the 7 to 12% range is very doable, which is double your money in the next 10 years. And that's what it works. So yeah, lifeassetllc.com. Yes, you will talk to me. You're not going to talk to somebody in some call center over in the Philippines. You're actually going to talk to me. That'll be me on the Zoom. You're getting me in real time. Okay.
Awesome. Well, yeah, guys, go ahead and check out Ben over at lifeassetsllc.com if you guys are interested to learn more and connect with him and see if this could be a good fit for you.
Yes.
Well, Ben, it's been a pleasure having you on the
Yes,
show,
great.
and I've enjoyed our conversation. So I greatly appreciate you taking time out of your day. And I know we've opened up the eyes of our listeners
Yes.
to potentially a new asset class for them. So yeah, thanks so much for hopping on, and yeah, I appreciate you. Have a great one.
All right.
Thank you
Hey,
so
Steve,
much.
thank you. It's been really great. I really appreciate it so much. Thanks.
Awesome. Aloha. Thank you.
Yeah. Thanks.
All right, awesome. Super cool conversation with Ben Mohr over at lifeassetsllc.com. You can check him out at his site if you're looking for an alternative investment. That's a very unique space. Again, if you're looking for some kind of a diversification of your portfolio, this is a potential way for you to be able to invest funds in there. And again, you are providing value to the seller of the policy. Like a lot of times, again, we talked about on the show, end of life care and just general end of life, it becomes can be a sticky subject, I think, for a lot of people. But again, you really want to live out your last years, I think, in the best possible way that you can. And this is a way that you can help provide liquidity to those that they already own the life insurance policies, but again, they're looking to kind of maximize what they have in hand in order to best direct it for them personally. And so, yeah, definitely a very unique opportunity in order to do that. Well, guys, if you're interested in investing with us, you can go to tricityequity.com to learn more about the multifamily projects that we have invested in and exited, the types of returns and whatnot that we've delivered for our investors in the past. And you're welcome to schedule a call with somebody on our team. We'd love to help educate you along the process and see what it takes for you guys if you're interested in investing with us. If you want to connect with other local like-minded investors, we have meetups every month. So join our Facebook group, Honolulu Multifamily and More. You can find us on meetup.com, Eventbrite, all that good stuff. I'm glad to connect with you in person. And if you guys are finding value in the podcast, please give us a 5-star review and subscribe to the show, depending on what channel that you're listening on. We'd love to continue to bring on unique and interesting guests and provide tons of value to you, the listener. So, well, we'll see you guys on the next episode. Go out, take some action, and enjoy the day, live life. And we'll see you on the next one. Aloha.